Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, episode number 008, where we continue our conversation with Martin Estlander, founder and CEO of Estlander Partners. Another topic I wanted to touch upon is risk management. And I wanted to start by asking you a little bit about how you define risk. You know, what does risk really mean to you? And then how you go about dealing with it and managing the risk in terms of whatever target you have.
Yeah, sure. Well, I think the risk management approach that we run is sort of divided into two pieces, and it all dates back to when we're trading options in the beginning, and we had very little equity, and we were required by the exchange to make markets in all series, and from time to time we had to take on much bigger positions than what was sensible for our little equity pile.
Sure.
And that led to a philosophy where we really sort of look at everything from the worst case scenario, continuously sort of making sure that we can survive to the next trading day and never put on more risk than we're comfortable in holding, and that means both market risk but also operational risk. So you have to be extremely careful with how you operate and how you make sure that you have backups and integrity checks for everything you do so that you don't fail operationally. So that's something that our risk manager looks at continuously during the day, that all the aspects of the process are running smoothly. And then from a market risk perspective, the way we approach trading is really from sort of managing the left tail of the distribution. And the idea, I guess, is that if we have a future sort of distribution of returns, which has a mean, which is the volatility, the sort of volatility of the returns. That distribution also has a left tail, and the classical way of managing to volatility means that you have to make an assumption on the distribution to get a picture of the left tail. And in our case, we sort of switch it around and we just focus on the left tail, and then we let the shape of the distribution or the design of the distribution determine what the outcome volatility is. So our volatility varies more, and the left tail management is what we focus on. So we always, for each position and for the portfolio as a whole, we run extensive simulations of possible future price moves in each and every individual instrument to figure out the worst case scenario, and then we sum up all the worst case scenarios for positions, and that sort of defines our worst case outcome. Sort of assuming that when shit really hits the fan, then we will lose on every single position, and we need to control that for that event. So that's sort of the risk. We call it the Achilles risk, the Achilles heel that we have to keep track of.
And even through this different environment since 2009, have you found that this approach, which clearly is something that comes from your history, as you mentioned, that this approach is giving you the same results or profile as before 2009?
Yeah, I certainly would say it has. And well, just in 2009, when liquidity dried up and correlations really, stepped up to a new level because of all the deleveraging that took place and so on. I mean, then that risk sort of management approach, I guess, was less effective because it assumes high correlations in the very stressful scenarios. So, we certainly think it's worked the way we've expected, and it's delivered the results that we wanted it to do, but it hasn't sort of helped us in performing well in a very challenging market environment.
Sure. And to the investors nowadays, Martin, with all of your experience, I mean, what's the best way for investors to look at risk in a traditional CTA? Is there anything they can do in order to visualize risk? Meaning, is there a rule of thumb that you would use when you look at a track record and you say, it has such and such volatility, so you should expect such and such worse drawdown? Is there anything you found that gives people a good rule of thumb in that sense?
Well, I would probably advise people to analyze it really from the perspective of which periods or months maybe that are quite different from other managers and from others sort of representatives of the particular style, and then try to really understand why it is so different. And so that's something I would focus on. Then when it comes to the whole operation and the business, I would also look into how stable the organization is expected to be, and where people find the inspiration to work, and how driven they are by money, and how they are driven by other factors. And I think this is something that is really underestimated today, and I think will be more and more important going forward when people analyze managers and try to understand the dynamics of.
Sure. Yeah, no, I think there's definitely some questions I'd love to go a little bit deeper with you in a few minutes, because I think you have a very clear view on these things that you may not come across that often in our industry. Just as a final point on the risk management, is it possible to say or to give a number? I mean, not a specific number, but a ballpark number in terms of how much risk you actually take on any one opportunity? Is there a kind of a range where you would say that's actually how little, quote unquote, we risk in any one opportunity?
Well, I think on average, we might risk something like 50 basis points on a trade.
Okay. Because this number, I think, will surprise a lot of people. I think they look at CTA track records often and they see the volatility and maybe they're not actually appreciating that the individual risk on any one market opportunity is generally quite small. So I appreciate that. Now, part of risk management is, of course, to avoid drawdowns. But drawdowns are inevitable. And in fact, in our industry, or in the CTA industry, I should say, we spend most of the time being in a drawdown. So I wondered if you could take a little bit of time and talk to me about that. What do we learn from being in drawdowns, and also maybe talk a little bit about if you've seen any kind of difference between the drawdowns prior to 2009 and the drawdowns after 2009, because clearly the industry as a whole has suffered more, and certainly some managers have seen quite a big expansion in the drawdown profile in the last few years, even if they'd been around for 20, 30 years prior to this. So talk to me a little bit about that, if you would.
Well, certainly, and I would come back to volatility environment that we discussed in the beginning of the conversation.
Sure.
And really sort of, again, say that the fall in this volatility that has a very high correlation with the returns has been so extreme during this period. And I think this is the reason for the deep drawdown and for the prolonged drawdown. And I think this is what has taken many investors by surprise and also many managers by surprise. And obviously we saw the volatility be at the highest level in very, very long time in 2008. And looking at it from this perspective, this is the time where one should not have bought CTAs, but that's where quite a few investors got involved with CTAs, and they've now been just experiencing this steep fall, and they've been quite disappointed with the returns, and maybe don't understand why, but quite a few people have obviously redeemed and are not going to look at the space for a while, but again, I think that this is the main driver of the drawdown and the drawdown profile of this period. And again, it poses also a great opportunity right now. And this is the biggest difference from the past. And when you analyze everything from this perspective, it doesn't look all that strange at all. And in fact, the drawdown has been, believe it or not, lower than what one would have expected in this environment, probably pointing to the fact that managers have become better and better at managing risk and managing drawdowns.
But so if we just stay with this theme for a little bit, and now we've, maybe you and I have not been in the industry long enough to have experienced this before, but clearly it would have happened before if we go back even more decades. But knowing what we know today, do you think that there is something you found during this time that the next time it happens would put you in a stronger position to maybe even profit from an environment like this? Or is it just one of those things that these kind of strategies, just can't do well in?
No, I'm sure that there's a lot that has been learned during this one, and if nothing else, I would sort of advise investors to sort of balance the volatility exposure based on the environment. And when in a situation where volatility is really high and it's going to come down, obviously there are short volatility strategies, but many investors don't even want to touch those. But blending in some of that would certainly help out. And then it's hard to beat long only in an environment like that. So being more on the stable long-term long side in risky assets is also a good way of coping with a situation like that. But if you look more at our particular strategy, which is really meant and will remain very sort of pure in its profile, I guess we will, if we see such a huge increase in volatility and then a steep and falling volatility, then we will either need to change our approach, which I doubt we will do too much, but certainly we will make some adjustments so that the situation like this will be smoother next time. Sure. Whether we will see it during the next 20 years or not, I don't know, but it's not unlikely. But it's certainly the previous similar event was in 1974. It's 40 years ago. So,
well, let's hope, Martin, that we will have that conversation in 20 years' time, even if we have a few more gray hairs to share.
See if you have any hair.
Oh, any hair, indeed. Now, you talked a little bit about it early on in our conversation, namely the emotional roller coaster that we all go through during times of drawdowns, not just because of performance. It could also be the pressure that we see from investors, etc. Tell me a little bit about how you balance that. I know you touched upon it a little bit, but just because I think that is one of those things that will be really helpful for people, both on the investor side, but also for people who are maybe somewhat early in their career, and maybe they're going through their first really long drawdown at this stage. And so just talk to me a little bit about how what you found over the years tend to work for you to not be discouraged by these situations.
Well, yeah, that's how it's the risk is that the answer will be very, very long on that one. But if I really try to cut it down and shorten it, I would certainly stress a few things, and the first being that of really understanding what the drivers are in the business. Have a clear picture of what it is that the strategy is doing and what drives the strategy, and then relate what's going on to the actual environment, and based on that judge whether you're doing a good job or whether you're delivering what you promised to your investors, or whether your manager is delivering what he is supposed to deliver if you're an investor, and really mirror it against what's really going on and what to expect. And if you're sort of have that well defined and clearly sticking to your plan, sticking to your game plan, and doing what you're supposed to do, and you cannot argue that to everybody, to yourself, to your partners, your employees, your clients, your investors, then at least for me, that makes life a whole lot easier.
Sure.
And I guess we humans, what typically causes the most sort of emotional pain has to do with some form of being afraid. And the more you understand of what you're doing and the more you're disciplined in what you're doing, the less you have to be afraid of what's going to happen, what the future is going to bring, and just stick to your plan and be very disciplined and be very clear, very transparent in what you're trying to achieve and what it is that you're doing. Then I think that's been, at least for us, it's been extremely helpful within the communication with the investors. And you can. If you do a good job on that, then you can actually gain a lot of confidence from all your both investors and your partners and your employees, and you can strengthen your case.
Sure.
So I think that's sort of understanding what you're trying to accomplish and stick to your plan is really important. And then on a more personal level, again, we're emotions play a big part in our daily lives, in every decision we make, every sort of thought we have, and it's important to separate the emotion from the rational thinking. And if you can keep those two separate, I'm not saying that it's easy, but that's certainly something that one can practice. And if one can sort of keep those apart, then it's so much easier to deal with it as well, and that really reduces both stress and concern, and maybe even makes it easier to see things as they really are and make their judgments based on that. So I think that's sort of the two main parts. A bit philosophical, but that's how I view it.
No, it's important. I mean, I think it is important to get this and get a little bit deeper, because these are the things that maybe a lot of people are not asking when they come to see you, because maybe they don't want, maybe they don't dare asking you these questions. But I think what you're saying, and I think this is an important point, is that being a rule-based or systematic trader actually also fits very well into what you're saying, because it allows you to maybe in an easier way to separate the emotional side from the pragmatical implementation, disciplined implementation of the investment strategy. And maybe at the end of the day, this is why we still see firms in this particular industry having been around for more than 30, 40 years and still going strong.
Yeah, fully agree.
Now, on a more positive side, research, that's always a fun topic. So I would love to hear a little bit about how you go about research. What's a typical research cycle, if there is such a thing? What does it look like? And what you're looking for in your reviews, because I guess investors want you to innovate and make research all the time. On the other hand, not all investors like change. So how do you balance that?
Yeah, well, the research process certainly is continuous, but it's not as innovative every day as some of the other days. So sure. It varies, but basically it's continuous all the time, and it's extremely important to do that. But when it comes to our approach, we really take the view that we only research phenomena and drivers that we understand from a sort of fundamental or philosophical perspective. And although we have a lot of very, very talented, very strong academics on the team, PhDs in different areas, we do not do a lot of sort of quantitative number crunching. We're sort of more driving our research based on phenomena and drivers that we see in the market, that we think we have a clear understanding of why we could make money of them and why they would be beneficial for the portfolio. And then we do use strong quantitative methodologies to implement them and to test them, and do everything we can just to avoid overfitting of the models. And when you asked about the research cycle and implementation, I mean, in our case, we can sit on ideas for quite some time before we start implementing them. Typically, they can, it can take a couple of years before an idea gets to really a point where we start looking at implementing it from the initial idea. And sometimes it goes quicker, but typically we are very slow in implementing them, testing them really thoroughly. First of all, with small risk, and then gradually increasing, and really making sure that we've analyzed everything over the whole economic cycle or several economic cycles, to see that it's robust and that it's something that will work over time and over many, many markets, and it's just optimized for a particular situation. And, I think typical cases, we saw this in 2007. A lot of strategies got adapted to a lower volatility environment, and then they blew up in 2008. And, looking at how some of the really popular strategies right now, how they are also geared, I'm afraid, a little bit to the quite recent environment. And if the environment changes, then one really want to make sure that the strategy is tested properly, so that it doesn't cause any surprises then when the environment changes around quite a bit. So
sure. And speaking about surprises, but generally I think also it falls under research. How do you notice if something that's already inside the model stops working, or at least stops working the way you expected it to work? Kind of a yellow or a red flag. How does that? Because that's a difficult thing, certainly in my experience. How do you go about that? Or maybe you haven't had to deal with it in many instances.
Well, certainly. I mean, we've had red flags flash, and we've had to take action. And it's hard to give a general answer to that because so many of the components and pieces are quite different from each other. And I guess it has to do with having a clear understanding of what it is that one is trying to achieve, and whether the premises for that are still in place, and if that changes, then one needs to take action. Like, say we had a short-term strategy in one particular market that did extremely well for a while, and we increased the risk to that, and we had to really monitor the slippage and the profile of those trades, and at some point it turned out that we had become a bit too big in that market for that type of strategy, and the market had learned what we were doing, and the profitability really dropped quickly, and then we had to take very quick action to reduce exposure to that particular model. But that the shorter you go in your trading, the shorter the half-life of the models, and the longer the models, I guess, the easier it is to see them as robust and not having to react to them.
Sure. Now, I would like to leave the subject of sort of the technical side, so to speak, and move to just a couple of other sort of areas in our discussion. And one of the areas is just more looking at, the business side, or the industry as a whole. And I wanted to ask you something that has sort of recently come to my own attention, talking to some of your peers who have been around for quite a long time, and that is succession planning. Some of the people that I have had on have been already going through their business succession plan, such as Dunn Capital, for example, and Sunrise Capital Partners. Is this something that you've started to think about, having spent more than 20 years doing this, or is that not something that is quite on your radar just now?
Well, it's been a target for quite some time to make myself completely useless in the office, or unnecessary is probably the more English word. And I have 7 really great partners, and they can run the business without me. And the way we are structured today is that I have a CEO that runs the business, and COO runs the operations and the financial side, and risk manager, and then portfolio managers. And really I'm just trying to help out where I can, and perhaps bring some inspiration and lead the team to some extent, and then help out with the research and ideas. But really my role is more that of helping out rather than leading and driving at this stage. So we've worked with this already for a long time, and it's doing really, really well. And some of the other guys they are so much more efficient, and they are so much more capable, and I don't want to stand in their way, and try to do things that they do equally well. So it's been very natural, and if I wouldn't go into the office next week, they would hardly notice.
Now, we've touched upon a couple of times during this conversation about the industry as a whole, and the change in environment, which has certainly put some stress on the CTA industry. What's the biggest challenge for your firm now, do you think? Where do you see the biggest, I wouldn't say struggles, but what's the biggest challenge in a situation like this?
Well, I think certainly the fact that the drawdown has been long, and investors are turning away from the strategy. I guess that's a big challenge, and it will change, but it's just a matter of when. And from a running the business perspective, it's just to make sure that we run the business according to the environment, and are exposed according to this, so that we'll certainly be as fit as possible when it turns around, and investors will again turn back. But another thing that is quite noticeable is the fact that investors, in particular the sort of largest investors, they listen to the consultants, and the consultants, they seem to have a quite short list of managers that they favor, and they only favor the really big names. And so there's a big consolidation going on right now. But we see that cycle already changing. A lot of investors start to look for diversifying strategies and other approaches, and notice that some of the managers get quite large, and that it's good to find other sort of names that they can build into the portfolio. But that certainly has been sort of the trend, as we know. Sure. Very strong consolidation, and the consultants, the increased role of the consultants with a lot of new big investors coming into the market. And markets have, been driving this development, and I think that's another challenge. But it's natural; it happens in any business, and we just have to adapt to that and live with it, and make sure that we can be innovative and show that we can add value to the investors. And I think that will work out in the long run.
And speaking about investors and maybe investor types, during your career, you've been in hundreds of due diligence meetings and conversations. What do you find that investors are not asking you that they should be asking in doing their due diligence?
Well, certainly sort of the sources of inspiration for the team, how the organization is sort of finding its innovation energy, and how it sticks together, and what role does sort of the culture play, the corporate culture. A lot of the due diligence meetings have been so technical and focused around things that are quite obvious and evident in with today's technology and today's structures and regulation. They are quite sort of stable in most cases, but very few people understand that the sort of more corporate culture piece of the equation, which I think is very important. So I would certainly put that as a number one in terms of where I think the questions are going to go in the future.
Sure. And what do you find that investors have the most difficulty in understanding regarding these kind of strategies? Because, as you say, clearly they ask a lot of technical questions, but do they really understand the answers they get, do you think?
I think there's quite a few investors that have a struggle with the actual drivers of the strategy, and which is natural. I mean, it's not easy to grasp it, and these strategies are in many ways not intuitive. They, on the contrary, they're a bit counterintuitive in how they work and when they work, and makes it difficult for investors to grasp. It's so much easier to listen to a story about why a company is cheap and why it's valuable and why one should buy a particular stock or why one should sell a stock, from a fundamental perspective. That's so much easier to understand than trying to look into the drivers of the relationship between shorter-term volatility and longer-term volatility, and how that expands and how that is mean reverting, and the statistical sort of parameters around that. And so I think that's something investors are struggling with. But it's all up to us how we can communicate it. We need to become better and better, and being able to educate and illustrate what we're trying to say so that they understand it. So one should definitely not blame the investors. One should just look in the mirror make sure that one can improve on that part as well.
Yeah, and I think it's partly what I want to achieve with doing these podcasts, because I think that in many respects, when we sit down and we have these meetings, most, if not all, the conversation is all about how we do things and what we do in the first place. But actually, one question that I've never been asked is why you do it. and I think actually that's probably the most important question, and it goes a little bit towards your point about culture, drivers, vision, and so if people don't understand why we do what we do, it's perhaps difficult to understand what and how.
Yeah, very good point, Niels. And I think you're doing a great job with this podcast, and I'm sure that some of the interviews that you're going to make are going to be extremely helpful for listeners and for investors and maybe for managers as well.
Sure. Well, let's certainly hope so. Last topic that I wanted to touch upon before we finish, or the last sort of section, is what I call general and fun. So something which is a little bit away from the typical questions that people might ask. But the first thing I wanted, which is basically just tapping into your experience, and that is, in your view, what does it really take to become a good trader / in your case, CTA? What are the key traits that you need to have in order to succeed?
Well, that's a very, very good question, and a very important one to think about for everybody. But I think it goes not just for trading, it goes for anything. And that is that you really have to have passion for what you're doing. You really have to enjoy it. And if you do that, whatever it is that you do, then you'll get good at it. But you won't get good at it unless you really work hard. And in most cases, it really takes hard work. And you can accomplish that hard work with the energy you get from passion, from being passionate about what you do. And I think that's the most important thing. And for anybody starting out in the business or being in the business, every day ask yourself, is this what you really want to do? Or is this something you do because somebody else thinks it's cool or it's great, or maybe you do it just because you want to make money? And even that could be dangerous, because you could easily lose your the drive from making money. Either you don't want to make money anymore, or maybe you made enough money or whatever. But I think it takes something more than just a willingness to make money.
Sure.
One really has to be fascinated from the financial markets, and the fact that it's a new day every day, and there's new excitement every day, and you can never sort of solve the problem of how to trade them completely. You can always sort of find a good approximation of with your strategies, and you can always improve.
Sure, absolutely. Now, I have a feeling I know the answer to this question, but I'm going to ask it anyway, and that is there any personal habit that you have that you believe has contributed to your success?
Oh, Niels. I guess one has to be stubborn and persistent, and like to work hard. And
I would have guessed you would have said your meditation, actually.
Yeah, well, that came on a bit later.
Okay.
Yeah, I've only been involved with that for 7-8 years, and it certainly has helped a lot.
Sure.
And again, I think that the drivers in the market is our human mind, and the way we design our systematic strategies are, in a way, it's just sort of, as you already said yourself, to take out the emotional part of it. And if you can be systematic and you can rely on your game plan, not on your emotions, then you have a bit of an advantage. And, that goes with everything.
Sure.
And certainly, yeah.
Now, you've been around for a long time, Martin, and so there's been ups, successes, victories, But I'm sure there's also been times where you would say you failed. Maybe you didn't use that word, but where things didn't pan out exactly as you hoped or planned. What's been your biggest, and I use the word failure, but where do you think you failed along the road, and what did you learn from it? Because failure, I think, is probably often the things we learn the most from.
Yeah, of course. I mean, you're right. And, obviously I've failed many times, and there are many things that could have been done better, but it's one thing to learn is to always sort of analyze whatever happened and try to improve, and then make sure that you when you've taken that out of it, then just leave it behind and go forward and look forward and try to do it better next time. And it's hard to pull out any particular sort of concrete example that
sure
because it's hard to put it in its right context in a short period of time. But clearly dealing with your failures is one of the most important things in any business, and learning from them, and then just going on and keeping your eyes on the horizon and looking forward, and make sure you don't do the same mistake twice.
Absolutely. Martin, did you always know that you wanted to be an entrepreneur? You seem to have been an entrepreneur pretty much from the beginning of your career. Was that always something you knew?
No, I can't say so. No, I never had a normal job, that's for sure. I'm not sure I would be fit in a big organization either. So no, I didn't know that. But clearly my family have been entrepreneurs, and there's a lot of entrepreneurs around me. So it's been very, very natural for me, and I enjoy it. There's one of the best things about being an entrepreneur is that you can choose the people you work with.
Yeah.
And they are such an important piece of life. And, you spend such a lot of time at the office and working. So if you can have, great people around you, then that's really important. And I've been extremely fortunate on that part. And, without the team and without the great friendship and all the inspiration and energy you get from the people you work with, it's you wouldn't last too long. And it's one of the most important pieces of the business is to build a team and in a proper way, and find the right individuals, and then try to jointly find the inspiration for what you do, and make sure that you share certain values, and not just among you as individuals, but also share those values as a firm. And if you get the values between the individuals to fit in a certain way, and in particular if you get the company values to fit the individual values, then you find a lot of inspiration and a lot of fun, and it's very easy to work together, and in particular in difficult times. So
that is so true. Now we're almost there, Martin, but I just wanted to ask you as well, if you were starting over today based on all of the things you've learned, is there anything in particular you would do differently?
Oh.
or is that another one of those long answers that we...
Yeah.
The list is long.
Well, a lot of small technical details or certainly could have been done differently, and
sure.
There's many things I need to be very humble about your sort of shortcomings. But I guess the big picture, I always love what I did, and I love what I do, and I'm really passionate about the business and the markets and the organization. So, in the big picture, I wouldn't do it much differently, no. But a lot of small things that could have been done better.
Now, if you could ask one of your peers, for example, the next guest that I have on Top Traders Unplugged, if you could ask them a question, what would that be?
Oh, what would that be? Well, I guess it would be very interesting to hear sort of their story and their drivers and their inspiration and motivation, and that would lead to tens or hundreds of questions.
Sure.
I don't know. I guess it would probably have to do with where they find the inspiration.
Yeah. No, I think it's a very important area you've touched upon today, and not many people go in that direction. So I really appreciate that. Now, my last question to you, Martin, and again, you've actually already shared some personal things which could qualify to this answer as well. But I always tend to ask if my guest could tell us a fun fact about themselves that is not usually known by other people.
So you want to have some fun fact about me?
Yeah, if you have one that you can think about that other people might not know about you, that could be fun. And if you don't, that's fine as well.
Yeah, well, on the top of my mind right now is this sail racing, and running a sail team of individuals where everybody has to make a lot of commitments and efforts to be there every day, and I demand a lot from them. And what is it that make them come every day, and what is it that make me go there every day?
Sure.
I don't know. It has to do, I guess, with really trying to be devoted and inspired in what you do. But the funny thing is, I don't know if it's fun, but for me, it just comes somewhere, and I often don't understand why I do it and where the inspiration and energy comes from. It just appears.
Sure.
And I wonder, maybe I figure it out one day. But you have a saying here in where we are that you have a big fire under your ass, and that's why you're running around all the time like a maniac. And the fire I have under my ass is certainly a little bit too big.
Sure. Well, then in that situation, it's a good thing to be underwater at least. Then at least the fire is contained to some extent.
Yeah, that's for sure.
Now, before we finish our conversation, I really do appreciate all the time you've given us today. Where's the best place that our listeners, people who want to learn more about Estlander Partners, where's the best place to reach out to you and learn more about your firm?
Well, come and visit us. Everybody's welcome. We're open arms, either in Helsinki and in Vaasa, or on our webpage. And why not drop me an email or give me a buzz?
Sure.
Anything goes. Whatever technical media or way one prefers. We're always here.
Fantastic. So we'll make sure that all of the information will be on the show notes page of this episode of Top Traders Unplugged. And thank you so much, Martin. Thank you for your generosity with your time, and thank you for sharing and being open about your own experiences and insights about your firm, your strategy, and of course our industry as a whole. I thoroughly enjoyed it, and I hope we can connect at a later date and get some updates on all the great work you do. And and I wish you all the best of luck with your sailing and the competitions you're heading into later this summer.
Yeah, well, thank you, Niels. It's been a pleasure talking to you. I think it's a great thing you're doing, and certainly very, very good questions and inspiring questions. So thank you very much. It was a great pleasure.
You're very welcome. Okay. Take care and all the best.
Yeah, you do. Thank you.
You're welcome. Bye.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.